Hello everyone, I think Amazon's fundamentals will reach greater and greater heights in the next 12 months or so, and this will likely cause the share price to follow along despite reaching all new highs. So I'll be discussing my thesis on this, what we might be able to expect from Amazon's earnings reports going on from 2024, and how this might impact the share price of the current highs we're already seeing. If you're new to the channel, I invest in high quality companies with fast growing free cash flow. My main holding of which is actually Amazon. So obviously I may be biased on this one. But if you want to follow along with this video and others just like it, then feel free to give this one a like and don't forget to subscribe to the channel. Now getting right into it, why do I think Amazon will skyrocket fairly soon? Well, it's already started to. It's up over 11% for the month and 30% year to date. So people are probably saying, well, Jordan, it's easy to say that it's going to go up because it's already going up. There's obvious reasons why it's going up. But I'm actually talking about the fundamentals behind this business. The profitability, how they make money and how little changes they're conducting as part of their business are having a massive impact on the profitability and free cash flows this company is actually producing, and therefore the share price. This company is quite literally famous a few years ago for not making money, for having such high capital expenditure and low margins that they had negative free cash flow for years. So from 2021 to 2023, they had minus free cash flow. And this wasn't just small amounts of free cash flow, negative 100 or 200 million. We're talking 29.8 billion negative free cash flow in June 2022. That's a staggering amount that not many companies could actually financially recover from. But Amazon did recover from it, and staggeringly so. They actually complement this by saying that basically they have swings and flows in their business. They have massive high capital expenditure for periods of time, and then they turn to profitability. They call it like a pendulum swing. But they did this quite recently. They've swung to profitability, and we're seeing this in the free cash flow numbers. They now sit at $45.7 billion, and I think that's going to increase going into the next earnings reports. And that will automatically mean that the share price will probably appreciate, in my opinion. So it's taken them a year to get from minus $8 billion to plus $45 billion in free cash flow. And I think that's a staggering thing that not many companies could just flip the switch and do. Now that's because there is very specific things this company is doing to make themselves more profitable. Expanding on those margins, and notably because free cash flow is actually not the best way to value this company. That would be more in the basis of operating cash flow. But we'll get into that a bit later. Focusing on the first part about Amazon, why was their free cash flow looking so bad and how has it improved so much? Well, one of the reasons is their research and development. Their capital expenditure was that high. If we look back at their capital expenditure when their free cash flow was at its lowest point in June 2022, that 29 billion free cash flow negative number, we can see they spent 65 billion in capital expenditure. So essentially they were spending more money than they were making for that year by 29 billion. That's a huge amount of investment that they're putting into their company. We see them building up their infrastructure, building up their AI capability, putting loads of money into AWS, even when it wasn't making that much money back. That was causing these sort of numbers. And then we see them reach a turning point with their free cash flow, and we look at the capital expenditure again. Now it's only gone down by a little bit. It's gone down to about 50 billion more recently. But that's still massively high investment in the infrastructure for a company that's been doing so much capital expenditure to build up its infrastructure already. So they've only gone down by about 12 to 13 billion in capital expenditure from those negative free cash flow years. So there's still more going on than just capital expenditure, but that 12 to 13 billion dollars goes straight over, when they're not spending it to capital expenditure, to operating cash flows. So now we know that Amazon has massively invested in its own infrastructure using capital expenditure, and that this number hasn't gone down massively, we can look maybe to the switches up in profitability we're now seeing this company. And that's mainly come due to margin expansion. If we go back to 2022 again, when this company was sitting at minus tens of billions of dollars in free cash flow, we could see that Amazon's operating margins were sitting at their lowest ever point at 2%. And since that time, they've nearly 4 times them to 8%. So we're seeing a massive level of margin expansion rapidly, and it's actually groundbreaking for this company. The highest margins they've ever sat at is right now, and that's making the operating and free cash flow go through the roof. We see this business turning a higher profit from services that are higher margined and cost less for the business to run. Additionally to that, the day-to-day running of their e-commerce business is actually being optimized by Amazon to improve profitability and cut down on costs. But what high margin services are actually improving these margins for Amazon? Well, there's not just one, because obviously it's Amazon, so there has to be loads. We take a look at Amazon's most recent earnings, and there's a few obvious winners in net sales that are producing greater and greater amounts of cash. Their e-commerce is growing at a respectable 7%, but that's not the high margin services we're seeing. They are in fact third-party seller services, advertising, and AWS. Now you could actually include subscription-based margins and operating services. However, I'll leave it out for now as I want to talk about the other three, mainly due to the fact they're experiencing higher levels of growth and they're more profitable. So first off, third-party sellers. This service grew 16% year over year. Now the reason this is better margin than the normal e-commerce side of the business is the obvious. Amazon doesn't have to buy the stock, someone else does. However, they've had problems in the past distributing and storing it due to Prime's next day delivery and a few other things. So through big capital expenditure that we covered earlier, they've now built out the logistics of their network and stores for themselves as an e-commerce platform to streamline their normal day-to-day running. And they're now offering that service of distribution and storage to third-party sellers, saying they are allowing them to store items in their upstream and low-cost warehouses that can either automatically replenish into their own fulfillment centres or move to other facilities that will pass them on to their end-to-end customers as part of the Prime service. So going on to say that third-party sellers find value in Amazon being able to manage those components for them versus having to do it themselves, and they're saving money in the process. So Amazon can put more third-party seller items on sale as part of Prime. This is due to the fact they're helping house and ship the products themselves, and they're actually charging the sellers the privilege of being there. So effectively, that is causing a massive helping expansion in terms of growth for profitability in this area, and also creating another form of revenue in the form of charging third-party sellers storage and distribution costs. And then we have Advertisement, which has grown massively year over year to 24%, which Amazon sees as driven by firstly sponsored products advertisement, and then of course their streaming service ads on Prime. They say they see an opportunity in this area and say it's early days with advertising on Prime and want to see the impact of subscription sign-ups and brand value, but the early response is quite encouraging. To me, this is just an awesomely margined business, and it shows a higher profitability if we look at other businesses. If we can look at the Googles and Netflix and see how they have manipulated streaming services into becoming massive sources of revenue through advertisement, we could see maybe where Amazon will take Prime. But that's maybe just being hopeful as an investor. And finally, we come to AWS, which grew 17% year over year and is already the #1 cloud AI service. So this is an expanding area for Amazon that is highly margined, as software companies tend to be. It doesn't need warehouses that are downstream or distribution networks that cost millions to run every day with employees at every level. It does need to stay ahead of the game though, and it does have high capital expenditure in terms of building the infrastructure to begin with. So to stay ahead of the game, Amazon are constantly working to improve their AI capabilities and expect the capital expenditure surrounding AI and AWS to even go up in further segments and earnings reports. So I expect we'll see AWS's margins sort of reduce a little bit, that maybe that profitability will get squeezed a bit, but we've seen a rapid growth in the 17% year over year growth. So I do believe that it will continue to remain profitable and continue to actually cover that capital expenditure going forward into these earnings reports. So what do these three services mean for Amazon and its future fundamentals? Well, I think it will continue to keep those margins high, as they have previously shown they're doing with improvements more recently. With these services growing faster than their e-commerce side of the business, I believe those margins will always be likely to do that. These services were always likely to produce higher and higher levels of profitability with how fast they were growing. It was simply a matter of time where they overtook the capital expenditure that's going into them, a bit similar to AWS. So as these companies end up producing more and more parts of the revenue that makes up Amazon's balance sheet, I think we will see expanding margins and resulting in higher levels of operating cash flow going forward into this year. So my reason and thesis is that I believe that the share price and fundamentals of Amazon will continue to improve. And that's mainly due to the fact that the high margin services, the likes of Advertisement, AWS and third-party sellers, will continue to become bigger and bigger parts of the revenue stream for Amazon. And as that happens, the margins will continue to expand and operating cash flow will continue to rise for this company. So in terms of the best way to actually value Amazon, I think operating cash flow offers the most truest representation of how the company's doing. And historically, that's shown the closest relationship to the share price. So if we take a look at it now, we can see that it sits around 20 times operating cash flow at its current share price, which, with the improved profitability that we've talked about, has historically sat at a median of 24 and an average of 26 over the past 4 years or so. So it's still sitting below that, and right now it's below its historic averages in price to operating cash flow. So if you ask me, there is still opportunity in Amazon with its growing areas of high margin business and the historical operating cash flow still looking undervalued. But what do you guys think? Do you like Amazon? Do you think it's a buy or a sell right now? Let me know down below. And as always, thanks for watching. I do appreciate it. I'll see you in the next one.